Hi, welcome to this video on generation skipping transfer tax. I'm attorney Kelly Longtin, the founder of Kelly Longtin Law, where we provide effective estate planning for our everyday families. Let's talk about generation skipping transfer tax. Now, when it comes to federal taxes, most people are very aware of the federal income tax because if they earn a paycheck, they cannot help but notice the deductions each pay period. But there are lesser known taxes such as capital gains tax, which is a form of income tax, the estate tax, the gift tax, and the generation skipping transfer tax, which perhaps may be the least known tax scheme. So let me explain to you what the generation skipping transfer tax is. The generation skipping transfer tax is a federal tax on an individual's transfer of property to a person at least 2 generations below that individual. Generally, GST tax applies to gifts made by an individual to grandchildren or descendants of the grandchildren. Gifts made by an individual to unrelated persons other than the individual's spouse can also trigger GST tax. The types of recipients who would trigger GST tax are commonly known as what we call skip persons. The GST is imposed whether the transfer occurs as a gift during the grandparent's lifetime or at the grandparent's death through an inheritance by a will or a trust. Now, Congress first introduced the GST tax in the mid-1970s to close a loophole that allowed wealthy individuals to evade inheritance taxes by transferring property directly to grandchildren and skipping the grandchildren's parents, which avoided estate taxes at the first generation. While the GST tax follows the gift and estate tax lifetime exemption limits, the GST tax is a separate tax that applies alongside and in addition to any gift and estate taxes. So the GST tax typically applies when the amount that is transferred to the skip person. So a skip person is a person 37 and a half years younger than the transferor. Where the IRS got that number, I don't know. Where the skip person is greater than the transferor's lifetime GST tax exemption, which is $12.06 million in 2022. All lifetime gifts, as well as transfers made at death by a will or a trust, are counted against the exemption amount. For example, if you give $100,000 to each of your 5 grandchildren in 2022, then $500,000 is counted against your lifetime exemption of $12.06 million. If total transfers during life and at death to grandchildren exceed the exemption amount, a flat 40% tax is then assessed on the overage. So there's an exception to the GST tax if your child predeceases you. The transfer of property to a grandchild where the grandchild's parent had already passed away does not result in the imposition of the GST tax. Since transfers from a parent to a child are not considered generation skipping, the grandchild essentially steps into the shoes of the predeceased child who is their parent. The GST tax does not apply to tuition or medical care payments that are made directly to an institution, so a school or a doctor or a hospital. For example, a grandparent can pay for a grandchild's college tuition without worrying about GST as long as the payment is made directly to the school. So there are some other things that you have to consider. While most people will not have to deal with the generation skipping transfer tax or the issues involved because the value of the property transferred is not greater than $12 million, but it is important to be somewhat familiar with the GST tax and when it applies because under current law, the GST tax exemption amount is set to revert to $5 million, which is adjusted for inflation, in 2026. Likewise, proposals to lower the exemption amount are regularly introduced. Thus, the GST tax exemption amount could change at any time. So if you're considering transferring property to grandchildren, you should definitely be aware of the GST tax. Another thing to keep in mind is that although married couples have essentially double the exemption amount, the GST tax exemption is a use it or lose it. Unlike with the estate tax, where the first spouse's unused exemption amount can be used by the surviving spouse, any unused GST tax exemption amount is lost at the first spouse's death. Now, the careful reader of the short explanation or listener of the short explanation of the GST tax may lead you to have even further questions. Suffice it to say that this topic can be very challenging. Now, very few tax advisors or attorneys are familiar with the complexities surrounding the GST tax. That's why it's crucial for you to seek experienced legal and tax counsel if you own property sufficient to trigger the GST tax that you intend to pass on to future generations. Doing so will ensure that you make the most of the tax rules and related GST tax planning strategies available to the advisors. And because these rules can and do change regularly, you should revisit multi-generational planning with your advisors on a regular basis. So I want to thank you for watching this video. I hope you found it helpful in your understanding of the generation skipping transfer tax. I'm attorney Kelly Longtin, founder of Kelly Longtin Law.